This is Sovrun, your guide to financial literacy. Today we're measuring the one thing every Wall Street trader checks before they check their returns. March 16th, 2020, the S&P 500 dropped 7% in a single day. The VIX, Wall Street's fear gauge, hit 83, the highest closing level ever recorded. 5 months later, the market was at all-time highs. That wild swing in both directions, that's volatility. Professionals call it sigma, and it's the single most important number in risk management. Volatility is the speedometer of uncertainty. It doesn't tell you where an investment is going, just how bumpy the ride is. Think of two flights from New York to London. Both land safely, but one had smooth skies, and the other had you white-knuckling the armrest for 6 hours. Same destination, wildly different experience. That turbulence, that's what sigma measures. A stock with 15% annual volatility means its price typically swings within 15% of its expected return in a given year, in either direction. Here's how you calculate annual volatility. Start with daily closing prices. For each day, take the natural log of today's price divided by yesterday's. That gives you the logarithmic return. Now find the standard deviation of all those daily returns. That's your daily volatility. But we want the annual number, so we multiply by the square root of 252, the number of trading days in a year. Why the square root and not just 252? Because price moves partially cancel each other out. A stock goes up 1%, then down 1%. The net move is roughly 0, not 2%. Variance adds up linearly, but standard deviation grows with the square root of time. The square root of 252 is about 15.9. So if daily volatility is 1%, annual volatility is roughly 16%. So where do real assets land? Savings accounts sit near 0. Basically no turbulence. US bonds are around 4%. The S&P 500 averages about 15%. That's the market's normal heartbeat. Gold is similar at 17%. The Nasdaq runs hotter at about 20%. And Bitcoin? Around 60% annual volatility. Higher potential returns, but a much, much rougher ride. In 2017, markets were eerily calm. The S&P 500 had its lowest volatility in modern history, just 6.7% for the year. The VIX touched an all-time low of 8.56. Investors got comfortable, too comfortable. A wave of money poured into short volatility products, essentially betting that calm would last forever. Then, on February 5th, 2018, it all blew up. The VIX more than doubled in a single session, from 17 to 37. The XIV, a wildly popular short volatility product, lost 96% of its value overnight and was liquidated. Billions gone. They called it Volmageddon. Low volatility wasn't safety. It was the calm before the storm. Here's something most investors don't realize. Volatility doesn't just measure risk. It actually eats your returns. It's called variance drain. Here's how it works. Say you earn 10% average returns with 10% volatility. Your compound return is about 9.5%, barely any drag. Now keep that same 10% average, but crank volatility up to 30%. Your compound return drops to just 5.5%. Push volatility to 50%, you actually lose money, despite averaging 10% per year. The formula is simple. Compound return roughly equals average return, minus half the variance. Sigma squared divided by 2. That's the tax volatility charges on your wealth. This is why professional investors are obsessed with sigma. The VIX gives you a real-time read on market fear. Portfolio managers use volatility to size positions. Higher sigma means smaller bets. And when you compare two investments with the same return, the one with lower volatility will always compound to more wealth over time. Volatility isn't just a number. It's the hidden force that separates good portfolios from great ones. And sigma isn't just for finance. Weather forecasters use it to model uncertainty. Six Sigma in manufacturing means fewer than 3.4 defects per million. Clinical trials measure drug reliability with it, and seismologists use it to predict earthquake intensity. Follow Sovrun for more financial insights.